Hi, everyone. Brian Christopher from Banyan Hill here. Welcome to another edition of Market Insights. This week, I'm talking with Ian King, editor of Banyan Hill's Automatic Fortunes and Crypto Profit Trader. And honestly, just an all-around smart guy. Ian, welcome. Thanks for joining me today.
Hey, Brian, thanks for the intro. Nice to see you.
You too, man. For the next few minutes, we want to talk about volatility. Ian's Sovereign Investor Daily article from Friday was about this. Before Ian and I chat, though, remember to subscribe to our YouTube channel. Click on the subscribe button below, and then click on the image of a bell that'll alert you whenever we post something. So, Ian, let's get right to it. The broader market's been acting like it's May all over again. Since last Wednesday, the Fed cut rates 25 basis points, and then President Trump tweeted that he's going to increase tariffs on the Chinese again, and that was all she wrote. Volatility has skyrocketed. The CBOE volatility index was 12 on July 26th, then popped above 24 on Monday. That's a crazy move in a very short period of time. Can you tell us a little bit about what it means and how we should think about it as investors?
Sure. And like you said, things are getting kind of crazy right now. The VIX, which is the volatility index, which measures the volatility of the S&P 500 stocks. And I just want to pull up a chart right now for our viewers. If you look at this chart, you'll see that big spike that Brian talked about recently. And this also coincides with the sell-off we've been seeing in the markets. There's a lot of fear in the air. And the way to think about the VIX is really what are people willing to pay for insurance on the market? Because the VIX is calculated by looking at option premiums. And when option premiums are higher, it means people are more likely to buy puts as an insurance against their stock portfolio. So right now, insurance on the market is much more costly than it was at the beginning of August. If you want to hedge your stocks, it's going to cost you a lot more. So that's the way I think about the VIX. But I want to turn to something else though, Brian, because the VIX is one thing, and then we can also look at the vol of vol, and this is called the VVIX. So you can look at the VIX as insurance, but then you also want to see how quickly that insurance is going higher. And I find this to be a better indicator for the future direction of stocks. So think about it this way. Everyone has car insurance. Your premium is probably $100 to $150 a month. Now, the insurance is one thing, but have you ever thought maybe your premium suddenly was going higher? What does that mean? It probably means that there's a lot of accidents or a lot of car thefts in your neighborhood. So you want to look at the change in your insurance premium, and that's what the VVIX measures. And I want to show you this chart. Since January 2014, there have been 9 readings with the VVIX over 120. And in 9 out of 10, actually, we had one recently. In 9 out of 10 times, the VVIX moved over 120. The 3-month return of the SPY was positive with an average gain of 5%. Now, something else I want to note is that the VVIX dipped as low as 60 and as high as 210 in August 2015. I don't know, Brian, do you remember that morning in August 2015 when the Chinese yuan was going crazy and the Dow dropped 1,000 points on the open?
Yes.
Yeah, those are good times back then. But that was the bottom in August 2015. The market actually rallied after that. And then just most recently on October 15th, we hit a high in the VVIX of 120. And that was before the most recent high in the VVIX, the last time we hit above 120. And what's interesting about that is that that wasn't the low for the markets. If you follow the markets into the fall and December, the markets didn't really bottom till December. There was a low in October, the market rallied, and then the big sell-off came in December. And then but the VVIX did not show panic in December. That was one of the few times it didn't show a reading. And the reason for this, I think that in October, the Fed was still hawkish, and they didn't turn dovish till December. And that's when the markets kind of bottomed. So what I'm looking for now is the Fed changing its mind on the markets right now, and what are the rate cut expectations going forward, and how are they changing? And so that's for me, that's the most important thing right now.
And really what you just laid out, you're talking about the SPY, which is the S&P 500 ETF. And it's really when you actually look at the chart, which is involved and there's a good amount going on, but people can look at that and follow the VVol in the future for potential trading opportunities. Is that right?
Oh, absolutely. I think that every time the VVIX gets near 120, it is a signal to buy stocks. And I think one thing that you and I have spoken about is, as traders, as investors, we embrace volatility. We don't run from volatility. We know that we have a portion of our portfolio that's in cash that is just set up for opportunities like this. And maybe it's not a trade that you need to hold on to for a long time, but you can make a quick 3 to 5% on days like we had on Tuesday, when the market opened up at the lows and volatility peaked at the VVIX came close to 120.
Yeah, I've found now that I embrace these times because by definition, I have a little bit of cash set aside for opportunities and things that I'd really like to buy if they fall to a certain price that, strangely, I could say I'd really want to pay. And now, actually, some of these trades, I think I make them unconsciously because it's like, well, that's a great name, and now it's down 20% for no great reason, at least no fundamental reason, and it's something that we can take advantage of. So that sounds like something that you do as well.
Oh, absolutely. And speaking on that note, I want to also highlight this fear and greed index, which is now an extreme fear. So there's that old saying that Baron von Rothschild said sometime in the 18th century: when there's blood on the streets, then it's time to buy stocks. If you want to see when there's blood on the streets, just look at what the fear is doing right now. The fear and greed index, I'm going to pull this one up for our viewers, is now at extreme fear. It's at 25. A month ago, we were in greed territory at 59. A year ago, we were in greed 73. And just a week ago, we were 48. So you can see how the fear has really crept into the markets, and it's just a buy signal for me. And really, it's not rocket science. As everyone's panicking, and it's time to pick up stocks that you can buy a lot cheaper than you could a couple of weeks ago.
That's right. And our listeners have likely seen gold and silver prices rising as fear increases. Gold closed above $1,500 an ounce this week for the first time in several years. And I've seen Bitcoin rising, but I haven't seen as much about it and other cryptocurrencies in the news. I know your Crypto Profit Trader subscribers are probably enjoying these moves. Could you talk a little bit about that recent uptrend and if it's, related to the things that we're talking about?
Sure. We've been following the price of Bitcoin, I think, since the bear cycle ended in December 2018. And the narrative in especially Bitcoin has shifted this year. There are more institutional investors moving into the market. There are platforms such as Fidelity that are making it easier for institutions to own and custody the asset. And then another thing is, Bitcoin is a form of money that has no centralized control. So it's not run by a bank and it's not run by a government. So in times of turmoil like we're seeing now, where the Chinese are letting the peg go against the dollar and their currency is depreciating, investors move to something like gold or silver. And for the first time, I think they're actually moving into Bitcoin as a store of value. And so that's been really great for investors in Crypto Profit Trader. But in the crypto markets, it really is just Bitcoin that has been moving up. The other sort of altcoins are kind of staying behind. But the cycle happens where Bitcoin moves up first, and then people move out of Bitcoin into these other speculative altcoins. But yeah, it's definitely the volatility, the global volatility, and the geopolitical situation, especially when it comes to what's happening with currencies and with central banks continuing to push rates lower, has been good for Bitcoin and Bitcoin investors.
And you've made at least one recent recommendation on an altcoin that people can play for a potential upcoming uptrend, right?
Sure, we have not that I want to talk about it right now.
No. That's for your subscribers, but you are seeing opportunities now where the altcoins are probably gonna start moving.
Oh, absolutely. And just, we had the mania in 2017 and we had the big bear market in 2018. The development on these decentralized protocols just keeps moving forward. And I think we're getting to the point where you're starting to see some adoption. There's one token in particular you're talking about is already working with a large bank in Brazil to do what's called securities tokens, where they can take real world assets, tokenize them, and make them tradable on a financial market. And I think that's a huge advantage to blockchain, and we're starting to see these things actually happen in real life. I think there was one more thing that we wanted to talk about on this webinar, and it was about the Fed and how the Fed is shifting. I want to pull this up for our viewers right now, and Brian, maybe you can comment on this. This is a chart of target rate probabilities for the December 2019 Fed meeting. I think this is the most important thing happening in the markets right now, because you've got fear, the market is sold off, but the Fed is changing its tune. A month ago, there was a 40% chance that the end of the year we would have 175 to 200. So that's only another 25 basis points cut from now. The chance is now 11%. The most probable chance now is 125 to 150. Actually, the rate hike odds, most probable is 150 to 175, but there's a 38% chance that we get 75 basis points of cuts this year. And Brian.
But wait, that's on top of the 25 we've already had, right?
That's on top, yeah. So current right now is 200 to 225, and we could see 125 to 150. There's a 38% chance. Brian, tell me what's going to happen to the stock market if the Fed cuts by another 75 basis points this year.
We're going higher. I mean, there is some underlying, there is some underlying worry. It's like, why are we cutting so deeply, and why do we have to do this? But the initial response is blast off, man. It's melt up mode.
I mean, I couldn't agree with you more. It feels like the same movie we saw in December, where there was fear in the markets. The Fed shifted towards more of a dovish posture, and the market was anticipating that they were going to cut rates, and the Fed followed through on cutting rates this year. And I just think that this will sowing the seeds basically for the next ramp higher in stocks.
Well, and also just more recently, even just the May chart, right? Like the May into June 3rd, when the May, we have these great stock charts. They go up at a 45-degree angle. The May chart of the S&P was kind of the opposite. It was going down pretty steadily, and then on June 3rd, Chairman Powell said that he would be willing to cut rates, and that was the end of that. And it seemed like since last Wednesday, the market had started falling kind of in a similar fashion to May as well. So we do have these things that tend to repeat themselves in history.
So true. I call it dip then rip.
Dip then rip. There you go. That's great.
And it's worked for 10 years. So why stop doing it? If you're a dip buyer, you have been absolutely, fortunate to be buying every single dip for the last 10 years. When they stop working, then we'll shift strategies. But right now, you just got to go with what keeps working until it doesn't.
Yes. That's exactly right. And that's actually a great place to, I think, table this discussion. We went through a lot of topics, and people can always stop and rewind if they want to follow up on them, or but also before I get off, first I want to thank you guys for joining us for another issue or another episode of Market Insights. We'll have another one out on Saturday. And I do want to mention that at Banyan Hill, we have our annual conference that's coming up in September. It's the 12th through the 14th. It's in beautiful Amelia Island, Florida, and I'm told we still have some seats available. All of our experts will be presenting, but there's another well-known financial guru, Dave Ramsey, who will be there as well. And in these times of kind of, I'm not quite sure what's going on, the market's going up and down, we know that Mr. Ramsey has a lot of insight that can be helpful for individual investors. Our conferences are super well done, super top notch. And honestly, if you've never been to Amelia Island or haven't been in a while, you owe it to yourself to come back and visit. If you don't believe me, check out the Sovereign Investor Daily article that I did on Thursday. There's some nice pictures in there, nice places to visit. If you'd like to learn more, totalwealthsymposium.com. And I look forward to seeing you there, meeting you there, talking to you. I know Ian does as well. And as I said, we'll have a brand new edition of Market Insights this next Saturday. So on behalf of Ian, Mike Carr, Jeff Yasteen, Ted Bauman, and everybody else at Sovereign Investor Daily, thank you for joining. We'll see you soon.